Right, well, should we start things off? Good morning, good afternoon, and good evening, one and all. Thank you very much for joining us for this Outlook on Global Bonds conference that Michael will be giving us this morning. Should be scheduled for about 20-30 minutes with questions at the end. So I'll hand over to Michael now.
Good, thank you, Tom. Good morning, etc. to everyone. Thanks for attending. What I'd like to go through is the outlook for fixed income globally. This presentation essentially summarizes a short research note that we put out a few days ago on these same themes. Basically, what it tries to address is really two themes or two ideas. One is that there is huge amounts of liquidity which are being thrown into markets right now, and that is changing the landscape and pushing investors more and more towards a risk-on environment. We've been saying for some time now that we anticipate what we've described as a V-shaped recovery. It's not to say that we're going to get back to levels of economic activity we were in January or February, but effectively the speed of rebound is likely to be very sharp, and that will be reflected in risk asset markets, which seems to be underway. The threat there is really for what happens to bond markets, because bonds are typically held as a safe asset, certainly government bonds, and they're really in the firestorm of this liquidity. The second factor which is connected to that is how do you actually earn money in an environment where you have to own fixed income for regulation reasons or for prudent reasons, or as a hedge against equities, but basically yields are very low or negative. How do you make money in that environment? So what we're trying to do is to answer those questions. What's the general outlook in the face of this huge liquidity storm? And secondly, what's the best way of positioning within fixed income to actually make money from these from the outlook we're seeing? In terms of the first slide, what this shows is the scale of the liquidity boost that we've seen. In fact, in many ways, this doesn't really even do it justice. But what you can see on the chart is our normal liquidity cycle. This is an analysis of liquidity flows, savings, and credit flows into world financial markets, weighted by economic size. So America clearly has one of the biggest shares of that, as does China. And essentially what we're looking at is from the depths of, or the lows in sometime around the second half of 2019, what you're looking at is a huge expansion in liquidity that was underway prior to the COVID crisis, but has very plainly been accelerated since then. The timeline on the bottom basically shows how different asset classes respond to that liquidity inflow. And you can see kind of right at the beginning, the fixed income markets are one of the most sensitive areas to liquidity. Now, this chart on slide 3 is an interesting point to ponder. And I'm not saying it's going to be exactly the same this time, but it's well worth thinking about what liquidity does. And although many people at different times have been hugely skeptical about liquidity, and no one's really arguing in the long term that liquidity will radically change the real economic landscape, but at the end of the day, it does matter in the short term or short to medium term for financial assets. And what you can see here is a graph that shows the rate of change in terms of year-on-year growth in global liquidity. It's more dramatic than the previous chart in terms of current growth rates. And on top of that, in black, we've basically shown what world financial asset performance has been doing contemporaneously. Now, just to be clear about what that chart is showing, the orange line that is zooming higher towards the end of 2020 has basically been projected. So what we've done is we've incorporated promises or commitments that central banks have made in terms of their liquidity provision, and worked out what that would likely mean for the overall pool of global liquidity, which is how we calculated this to end December 2020. The black line is current year-on-year growth rates of financial assets. It's basically drawn up. It does not include, I should say, the end May data yet. That will be coming out in the next few days. But it basically shows up to the end of April the year-on-year growth in the performance of all financial assets quoted globally. So this is equities, corporate debt, government bonds, liquid assets, precious metals, in terms of a weighted portfolio determined by their relative sizes or importance in the world financial markets. So basically, it's a pretty good barometer as to what financial asset prices on average are doing. What this is saying is there is huge scope out there for this big liquidity boost to drive financial assets up. People are going more and more risk on. That's what you're seeing almost every day on Wall Street. And the fact is that if investors are going risk on, there's going to be a casualty somewhere, and that's likely to be the fixed income markets. Now, in terms of getting on to what is the outlook for fixed income, I just want to walk through a couple of items, which is basically how we look at the world. And it comes down to, in many ways, looking at liquidity or drilling down into liquidity and understanding the differences between what the private sector is creating and what central banks or policy liquidity is doing. And what we pay respect to is what we think of as the hierarchy of money. Money has different uses, different importances, and it's another way of, if you like, thinking of money in terms of a quality theory rather than a quantity theory. The type of money matters a lot, and it matters a lot for the fixed income and forex markets, as I'll try and show. What the graph in front of you is illustrating is what we're looking at is the US Federal Reserve liquidity in blue, and in orange we have the cash generation of the US private sector. Now, the two kind of move together, but there are noticeable dislocations, certainly on a month-to-month and probably on a year-to-year basis, but over the long term they tend to correlate pretty closely. In many cases, the private sector leads. That's not always the case, but generally it seems to be true, and central banks tend to catch up. Now, the way to read this data is that currently both the US private sector and the Federal Reserve are generating a lot of cash. The fact that the private sector is generating cash during what is a downturn shouldn't be a great surprise, because they did it with some alacrity in 2008-9, as you'll see, but it's happening again, and the Federal Reserve is coming in on top of that to add to that liquidity pool pretty quickly, rather like the response again in 2008-9. Now, if you look at this matrix, what we show here is basically how that corresponds, or those two dimensions correspond to exchange rates and in terms of bond yields or term premium, which is actually how bond yields respond to this. And what it's saying is that in an environment where you have high central bank liquidity, in other words, the Federal Reserve is pumping in liquidity, and the private sector is generating a lot of cash, historically that's been a time when bond yields tend to rise, and that rise has been underpinned by increases in term premium. And it's term premium which really matter. Recent studies by the New York Federal Reserve show us that something like 75% of movements in 10-year treasury bonds all down to movements in term premium rather than rate expectations. So tear up the textbooks, the sort of hypothesis of interest rates, short-term policy rates really mattering and driving bond yields is sort of out of the window. That doesn't seem to be the case anymore. If you look at the opposite quadrant at the bottom, where you've got low central bank liquidity, in other words, policymakers are tight and the private sector is cash starved, that's when you tend to find bond yields fall and term premium are challenged. And that's the environment that we've basically been in for the last 2 or 3 years. That's now changing. The other two dimensions, or the top left and the bottom right, are basically looking at exchange rate movements. So typically what happens there is that if you have tight central bank liquidity, but a lot of private sector cash generation, you tend to find currencies, i.e. the dollar in this case, is strong. And if you see very high central bank liquidity, central banks printing lots of money, but the private sector cash starved, you tend to find that the exchange rate suffers. And just for completeness, what does it mean for equities? Well, generally, you can see on the right-hand side of the diagram, when you tend to find that central bank liquidity is high, that tends to be a time when value stocks outperform. Notably, when bond yields tend to rise, the yield curve steepens, cyclicals pick up, and when you get a weak exchange rate, cyclicals do well. Equally, to make that symmetric, growth stocks tend to outperform on the left-hand side of the diagram. Now, to come to what really matters, which is the term premium story. And here what we've got is a chart which is trying to debunk the sort of the general view that comes out of central banks and a lot of academic economists that says whenever central banks ease liquidity, what you find is that bond yields go down. Actually, completely the opposite, they go up. And what you can see in this diagram, hopefully, are the periods of QE, and I've labeled or put the latest one in, which really started about the latter part of 2019. And what it's trying to show is that in each one of those QE periods, you can see that term premium, which is the thicker orange line there, basically rose pretty significantly in each of those periods. Now, at the moment, you're seeing term premium bottom out, but I would fully expect term premium begin to rise. And as they rise, bond yields are going to feel the pressure of that, and bond yields will begin to turn upwards. We're already beginning to see reassuringly, maybe in markets, that yield curves are steepening. Even through the last few weeks. It normally takes a couple of months for liquidity to feed through, but it looks as if it's feeding through in the correct way. Now, how do you make money out of fixed income in this kind of environment? And this is something which comes from the report we wrote, which is basically saying that actually, if you drill down into fixed income, what you find is that you've got three very independent sources of return. Most people tend to think of fixed income as a kind of buy and hold strategy, where your return is almost entirely determined by the level of carry you've got in the bond, in other words, the yield to maturity. Think about that. And if you hold the bond to maturity, that doesn't really waver. But actually, if you're thinking about bonds on a shorter term horizon, what happens is you've got three very independent factors which are driving the bond return. You have got carry, for sure, but that tends to be a small contribution in the short term. You've also got the slope of the term structure, which is the maturity spread or the slope of the yield curve, which basically includes contributions that come from roll down, for those that are familiar with that element of a bond return, and the reshaping of the curve. And then you've got the third element, which basically is volatility. Now you can think of these contributions as really coming from the level, the slope, and the curvature of the term structure. Each of those contributions are kind of independent and come from those elements. And if you look at the matrix below, what it's trying to show that even if you have a low level, in other words, a low level of carry in the market, the change in slope and the change in volatility don't really have it, or are not correlated at all with the level. So you've got very independent sources of return coming through here. So if you can separate off the low level of carry from the other two elements, the change in slope and the change in volatility, you've got a possibility here of actually making large and very independent and uncorrelated returns. And this is what we try and show in this diagram, which is basically a look back over different horizons of bond returns. Now, what it says is that if you look over the very long term, and the long term, which is called the entire period, actually is the period from 1946 right through to date. So it's effectively a 70-year period. And in that 70-year period, by far and away the bulk of the return from holding US Treasury fixed income, this is at the 10-year tenor, basically 90% of that came from carry and about 10% from roll down from the slope of the curve. In other words, from let's say a 10-year bond becoming a 9-year bond after one year and an 8-year bond after 2 years. That tends to be a contribution that comes and is termed roll down. Over a 10-year horizon, you can actually see that the contribution of reshaping, which is either a drop in the curve, an increase in the curve, a pivot in the curve, a change in the in the curvature, anything of that magnitude starts to come in at that time horizon. So if you're looking for returns over a 10-year horizon, what you tend to find is that reshaping becomes more important. Carry is still probably a dominant factor, and roll down becomes a little bit more important. And then as we start to progress for a shorter and shorter window, the effect of reshaping becomes more and more dominant. And what I've shown on that final column, which is month to month, is actually looking at the contributions through standard deviations to returns based on those three elements of reshaping, roll down, and carry. So the whole point here is that even though you've got negative carry in some bond markets, or certainly very low carry, if you start to actively manage your bond portfolio, you can actually make very decent returns. And that's really the point of this presentation. So if we look at slide 10, what slide 10 is looking at is US liquidity, which is the orange line, and the blue line is the slope of the yield curve. Now, what that says is that generally increases in US liquidity tend to precede movements in the yield curve by about 9 months. So in other words, if you see a big surge in liquidity, which is what we've been having, you expect to see the yield curve steepening sometime over the next 6 months, given the fact that some of that liquidity pass-through is already occurring. So we're looking for a period where yield curve should begin to steepen. Now, there are two things to say about that diagram. One is, why does it happen? And that is all to do with term premia. And because term premia are what you would basically pay, or a reflection, if you like, of the excess supply and demand for safe assets, if the demand for safe assets is very high, term premia will be low. And if term premia are low, 10-year bond yields are low. Now, the reason that term premia get bid down in this way is simply because 10-year treasuries are the canonical safe asset in the system. So if there's very tight liquidity and people don't want to take risk, they pile back into 10-year treasuries, the term premia gets bid down, and because term premia tend to have a bigger effect at longer durations than short durations, the yield curve will flatten. Contrawise, when liquidity goes into the system, what you find is that term premia rise and the yield curve steepens. The second point to note is what happened in 1997 to 2000, when you saw this big increase in US liquidity, but it looked like the yield curve flattened. And that was purely to do with the Asian crisis. If we'd have included in this not just US liquidity, but Asian liquidity and Asian cross-border liquidity, the fit would have been much more exact. And what happened at that time was that a lot of money left the Asian economies fearful of the crisis and piled into US treasuries and therefore flattened the curve. So if you take that out, the correspondence is much greater. And here is some regression analysis and Granger causality tests, which are virtually unambiguously show the strength of that relationship. What it basically shows is that liquidity unmistakably drives movements in yield curves. So what we've got to be alert to with all this liquidity coming through is that bond yield curves steepen, and given the fact that the front end of the curve is anchored by policy rates, you're going to get a steepening at the longer end. Now, further evidence. One of the other indicators we look at is risk appetite of investors. And risk appetite has been a very good predictor both of economies and of bond markets. And what we've done here is to take our US risk appetite index, to push it on by 12 months and to invert it. So the big rise in the blue line that you see occurring on the right-hand side of the chart is actually risk appetite collapsing, and that collapse in risk appetite is normally associated with increases in the yield curve, and that occurs because central banks are forced to come in to restore fortunes and to improve risk appetite, which normally happens. In other words, it's saying that the financial system and the economy is very cyclical, but we've got to pay attention to what's happening because this is the normal pattern. you would expect to see yield curve steepening right now. Another example, which is even more dramatic, is US economic expectations. Now, this is data that comes from various Federal Reserve surveys for the last month. So this is May data, plus the Michigan Consumer Survey. And all those various surveys basically have two questions amongst many, which is what do you think the outlook is today, and what do you think the outlook is in 6 months' time? And if you look at the gradient of improvement, this is the scale by which US respondents to those surveys think the economy will pick up. So what it's showing is a huge increase in economic expectations relative to the current. Now, that has been a very, very good prior predictor of what happens to bond markets. Bond markets are a lot more mathematical, a lot more straightforward in many ways than equity markets. And what this is basically showing is as the economy rebounds, you'd expect to see the yield curve steepening. So everything to date is panning out as one would suspect. Can the US Treasury really control the market? A lot of people have spoken about yield curve control. Well, let's just get this into perspective. The last time America did yield curve control was back in the period after World War II. Basically, it was, to be strictly accurate, 1942 to 1951, but 1945 is a pretty good, midpoint. And what it showed at that point, that in terms of who owned the Treasury market, although the Federal Reserve only had 1% of it and therefore could buy more, US banks held 41% of the Treasury market, foreigners only owned 1%. And if you look at the right, top right, you'll see that US banks' balance sheets were basically composed of virtually 2/3 were vested in treasuries. So it's not surprising that the Federal Reserve could actually exercise pretty good yield curve control. If you look at the lower charts, which are 2019 data, what it shows is that in terms of the Treasury market, the US Fed already owns 14% of the Treasury market and is going up more. Banks own barely 4%. OFI is probably 30%, similar to what they had in 45. But foreigners own a whopping 40%. So it's going to be really difficult for the Federal Reserve, I think, to exercise any degree of yield curve control. And even in occasions where you've seen yield curve control operating in Japan, the longer end of the yield curve has not been well behaved. There's been a very clear steepening at the 20 and 30-year tenors, even though they're targeting the 10-year. So good luck to the Fed if they try this, but I don't think it's going to work. Let's say something about the other element, which is looking at volatility. So in other words, that we've tackled the point about let's look at how we can make money out of the slow or shorter. The other thing to look at is what happens to volatility. And one of the things that we look at very closely is the volatility background of the bond market. Now, many people look at the VIX in equity space, but actually the move, which is the equivalent measure of volatility across the term structure for bond markets for US Treasuries, is actually a much more straightforward way of making money. It's much better behaved. You can use options in a straightforward manner, and you can basically be a value buyer of volatility to buy vol when it's low, such as now, and trade it out when it gets higher. We saw evidence of that in March of this year, February, March of this year. There have been occasions before where you've seen spikes. But what this diagram is basically trying to show is the fact that there is a very neat correlation between volatility in the US Treasury market and the growth rate of Federal Reserve, of US Treasury issuance. And what this demonstrates is the MOVE index, which is shown as the blue line on the left-hand scale, and the growth rate of US Treasury debt, which is on the right-hand scale, which we've basically put there up to the end of 2020, given the slated program of Treasury issuance by the US government. And what this is showing is you're getting a big hike in debt growth, and it's going to keep going through 2021 too. It's COVID. And it looks as if looking at the move index, you've got the move back at almost all-time lows again. So this has got to be a great time to be buying volatility. So if you put all this together, what it's basically saying is that if you split returns from bonds, you put them into, you pigeonhole them into these various areas, you don't have to worry about carry. Carry is an element that may matter if you're a buy and hold investor in bonds, but what you really want for bonds is the ability to earn uncorrelated returns and the ability to hedge equities. And if you essentially turn to those three factors, carry, slope, volatility, by taking out carry and ignoring that or managing that separately, you've got two other buckets where you can actually make money pretty systematically. Now, one thing I haven't spoken about is the inflation element, which is something which is a kind of bogey which is hanging out there in markets, which could be a problem. And this is something that, as I say, I haven't mentioned as to a source of rising yields and a source of rising term premia and volatility, but hey, it's there. And what I wanted to sort of finish with is this sort of question, which is in a way left hanging, but it looks at how inflation starts. And if you go back to the 1970s, which I just about remember, what you had then was a pickup in inflation that basically began through shortages. And one of the best ways to pick that up was to use the ISM supplier delivery time question, which is basically shown on the left-hand chart as the blue line. The orange line is US CPI inflation, annual US inflation. What it basically says is that supplier deliveries were an extremely good predictor of the change in the inflation climate. And the blue line here has been advanced by 9 months to show that it's a lead indicator. Now, Alan Greenspan, remember him, when he was Fed chairman, always used to say that the best indicator, or in fact, the two best indicators of coming inflation pressure that he looked at was the price of gold, and secondly, the US ISM supply delivery question. And I think this supports his view because it shows that if you start to get shortages, you start to get prices rising. Now, anecdotally, I think you can see, even through this crisis, evidence whereby consumers are being rationed and any idea of getting discounts has been thrown out of the window. You know, producers are not offering discounts very much now. If you're lining up in a store to get goods, most people full price or more. If you look at what's happening right now in the US, you can see that the supply delivery question has jumped, not surprisingly, because you've got supply side problems. But that's how inflation picks up. And so what you'd expect to see, I think, looking into 2021, is some uptick in inflation. Now, that definitely is not being priced in by the bond markets in any way, shape, or form in terms of the slope or in the volatility of the market or even yet in the carry. So all these things are upcoming. Bonds look bad generally, but a lot of people have got to hold them. How do you make independent returns from bonds? Go back to these elements. Look at volatility and look at the slope of the yield curve. As a final advert, that's what we do in our fixed income strategy. That basically invests in very liquid instruments worldwide. This is a UCITS fund, but basically we've been running this money in this form for 10, 12 years now in other strategies. And basically what it's trying to show is that you can, by systematically breaking out these various components of bond returns, you can avoid what will be potentially very ugly returns from bonds over the course of the next 1 to 2 years. And in our view, the risk is inflation, not deflation. The risk is risk on, not risk off. And bond yields are going to start to rise and yield curves steepen. So let me stop right now and see if we get any response to or any questions coming through from anybody.
Well, thank you very much, Michael. And if anyone has a question, then feel free to put it down in the chat at the bottom there. And Yeah, if you have any questions, then go ahead and I'll patch you through once you put it in the chat.
Otherwise, no problems, because this is designed to be a short call. There's an update slated on liquidity next week when we get the data, the May data in, and that should underscore the view that liquidity is rising. But unless anyone's got any particular points, thank you for your time. Oh, hold on, question coming in. Anything on exchange rates? Yep. Okay. Let me say something about exchange rates. And for that, I'm going to go back to the to my presentation and go here. So go here. Right. Okay. So, sorry. There we go. Right. In terms of exchange rates, what really matters is the deviation between private sector liquidity and policy or Federal Reserve liquidity in terms of currencies. What you're seeing here is basically periods where private sector liquidity exceeds central bank liquidity. This is strong dollar period, very clearly. Blue line above, orange line, weak dollar period. This period has been one of firm dollar in the last 2 years, little bit of dollar weakness back in 2016, but it's this differential which is really the critical thing, and that's what we say or show there in this matrix. So if you've got very high, if you've got very high private sector liquidity and low central bank liquidity, the currency should be strong. We are more in this area. So what I would tend to suggest is that the dollar is firm, bond yields are rising, that's the environment I think we're in. And if we go back to this chart and try and look at what's going to happen, I think that it's likely that private sector liquidity is going to peak here, start to come down, but it's going to precede the movement of Federal Reserve liquidity. So that would mean that you're going to start to get the dollar rolling over, and that's really what we expect to see. And therefore, what I would say is that it's non-dollar currencies, and I would include in that gold, which are likely to be the best, the best respondents to this coming environment. So I think we're in a gradually weakening dollar environment, and I think the final comment on that is that the alacrity with which the Federal Reserve pushed through these swap lines to 14 countries in March tells us they don't really want the dollar that strong. Let me see if there are some. There were some other questions coming in. There's another one here. Is growth in private capital a function of drawing down of RCFs? I'm not sure what RCFs and could reverse private capital.
Jeff, shall I just patch you through, Jeff?
Oh yeah, sorry. Okay.
Ask your question. You might have to do it on your side, Michael, as you are the host.
Revolving credit facilities.
Oh, there we go.
Is that it? Yep. Jeff.
Revolving credit facilities. It's the
oh, okay. Sorry, revolving
credit lines.
Yeah. Sorry, I see what you mean. Yeah. Is the growth? Yeah. I mean, the answer is that that's almost certainly true. That is something which is likely to be a factor. And so what you tend to find during these financial crises is that the corporates will draw down liquidity from banks or facilities when they can, and that's why you tend to find immediately after a crisis you see a very quick drawdown or fall off in private sector liquidity. Expect to see now. So I think that the answer is absolutely, which is something which may suggest that that period is one where the dollar does begin to roll. David Gibbs' question I've got. David, do you want to? I'll just read it out, David. Unless you can, maybe that's say it. But anyway, household savings. Can I say something about household savings? Well, the answer is yes. I mean, what you've seen is you've actually seen two things going on right now in the overall savings markets. One is that there's been generally increase in savings, and that's simply because incomes have been to a large extent maintained. I don't want to overstate that point because clearly in many cases they haven't been, but they have to the vast majority of people. There was something which I believe that I think Goldman of all people put out a few days ago, which actually said that the amount of money that's being paid out now in unemployment benefit in the US is actually greater than the income lost through job losses in America. So in actual fact, incomes generally seem to have been maintained, but spending has clearly fallen away. So arithmetically, household savings ratios have gone up. But the other thing that you've got is on top of that, the amount of liquidity that's come into the system that's been force-fed through central banks has actually largely accumulated in financial institutions. And so many financial institutions have been sitting on cash levels that some estimates will put 50% above normal. For example, if you look at US money market mutual funds, they've got levels of liquidity which are basically, they've increased by about $1 trillion, I was about to say, in the last month. And they're pulling in cash at the rate of about 200 billion currently a week. So there's a lot of money flowing into these areas. Now, typically, household savings and corporate and institutional savings tend to be fairly constant relative to GDP or income. And so these surges tend to be spent. And one of the things that you see historically is that high savings ratios dissipate, or high cash savings ratios dissipate into risk asset purchases and ultimately into real economy spending, which is why you typically find that these episodes lead to rising asset prices and ultimately more high street inflation. And so our view is that this year is definitively the year when you start to see big asset price moves, and next year is when you run the risk of more inflation. And, you know, will inflation happen? As I said, I don't know. It's a difficult thing to predict, but I think looking at things like supply and deliveries is going to be a really good heads up to that. Another question from Mark. Mark, do you want to answer that question? I probably unmute.
I don't know. I just want to ask you, think the yen
right?
versus
Okay.
euro.
I think the euro is likely to strengthen. The reasons for that are somewhat convoluted, but generally, if you look at what's happened to the yen, this is a kind of step back away from the specifics of fixed income. But if you look at what's happened to the yen, from 2017, the yen has mysteriously flatlined in terms of a basket against its peer currencies. And its peer currencies I would take as being, you know, let's say 50% US dollar and 50% other Asian units. And if you look at what's happened to the yen on that basket, it has been remarkably flat in a way that I've never seen in sort of 20 or 30 years of looking at financial markets and the yen. It's remarkable. So I'd have to say, by default, it looks as if they're targeting that. And what that basically is illustrating is a backdrop whereby the BOJ is intervening to try and keep the yen pretty stable. Now, I think that that tells us that Japanese policy has changed, and in many ways it's following the lead from Asia, which is really a Chinese lead. So generally, if you work out a conclusion from that, I would say that it means that if anything, the yen is either flat against the dollar, or given what China is probably trying to do, maybe slightly weaker against the dollar. And therefore, the bulk of any dollar increase, from what I was saying, is likely to be the European currencies. Now, why should the European currencies go up because there's this ongoing mess in Europe? I think it's simply because what you're seeing going on here, at least in my view, and looking at the capital flows and the liquidity responses, is that Germany is becoming the stronger and stronger economy in Europe. And the whole of the EU is more or less revolving around the German axis. They've been the first in with support measures. They've been the least willing behind the scenes to allow this sort of fund, this European Rescue Fund, to go through. I mean, they're sort of hiding behind the sort of frugal four, but the Germans don't want this really either. they're going to be a lot more. They've said they'll do it in terms of allowing some sort of support measures, but in return, they're going to look a lot more closely at fiscal spending by individual countries and look at tax takes and whatever. So there's a sort of quid pro quo there in terms of what they're doing. So I think that means Germany comes out of this stronger. And in a funny sort of way, I think that the other point that is in the background, and this may be a giant leap in terms of what maybe I'm saying, is that ultimately Germany is moving closer and closer towards Eastern Europe and towards Russia. And the EU is becoming more and more, at least I think, an Eastern European Union. If that's the case, that's going to essentially allow Germany to grow faster, and it's going to underpin the euro, or the Deutschmark within the euro. So it makes the euro look a lot more like the Deutschmark. And therefore, I think that the case for a stronger euro is probably there. That may be a sort of slightly maverick view, but I would tend to think that the yen weakens against the euro in terms of the way that I would think. Another question which has come up from David.
Sorry, can you hear me, Michael?
Yes.
Yeah, I just wondered, could we go back to page 7 on your presentation?
Yeah, I'll do that.
And whilst I'm on, thank you very much for this. It's very interesting.
Good, pleasure. Right, let me just. Sorry, page 7.
Yes, please. Yeah.
This one.
Yeah, and you were talking about spiking in interest rates before QE or whilst QE. If my memory serves me well, a lot of the spiking that went on was because everybody thought that QE was going to bring on inflation, which obviously never happened. And you're saying it's going to be different this time.
Well, I think it's different this time from two respects. Well, sorry, it's not different this time from one respect, but it's different in another respect, and that is that if you look at this chart, what it's saying is that I think that you're going to start to get term premia begin to rise. In other words, this orange line is going to rise as it did before during these periods. Now, if you look at the 2008-9 episode, you did see a lot of volatility at the beginning with term premia, but generally term premia rose through that QE period. And the view that academics and central banks have is that actually when QE was ongoing, term premia dropped. Well, I can't say there's any evidence of that. And actually term premia went up and bond yields went up. Again, you see QE2 and you see term premia generally going up, term premia going up and bond yields going up. When QE1 stopped, term premia collapsed, bond yields collapsed. When QE2 stopped, term premia collapsed, bond yields collapsed. Then you get QE3, term premia go up, bond yields go up. And then you get the end of QE3, term premia go down, bond yields are a little bit volatile, so that's rate expectations, inflation expectations coming in. Now you've reached the floor here, liquidity is supporting that, seems as if that's beginning to turn, maybe it's turning up, and I think that's going to drive bond yields higher. What's different this time is two things. One is this chart, which is on slide 13, which is the change in US expectations of the economy. Now, these periods here, where if you go back to 74 and you go back to 1980, the speed of this increase was actually coincident with rising inflation periods here. And we've seen a dramatic turnaround in terms of economic expectations. Now, there's a lot of reasons why it might be different this time, but it looks as if the evidence is showing a whopping great turnaround through April and May. And then we go on to finally this chart, which is looking at how does inflation start? And this is just a question that's left hanging, but it's basically saying that if you look at what happened in the 70s in particular, this was a period where you got a lot of shortages coming through. And that was the reason that inflation began to pick up and become embedded. Now, okay, there are other things going on. Oil prices went up, etc., etc. I understand all that, but basically we're in a situation where you haven't seen a rise in supply delivery times like this for an awful long time, and even surpassing what you saw back here in the recovery in 2009-10. So that could be a forewarning that this is how inflation starts, that basically people get rationed, goods are not in the shops, there is supply chain disruption, there's a lot of demand which has been stoked up, and the elasticity of the economic system supply that is compromised, and therefore prices start to rise, or at least discounts don't get given. And everyone is assuming, I think, that this is a big deflationary hit in the short term, which it may well be. But beyond that, there may be a question.
Thank you very much.
Pleasure. Pleasure.
So, Michael, can I just ask a quick question?
Go for it, yeah.
Yeah, it's again on the same on the topic of currencies. So, if Germany is tending to be more Eastern Europe focused, so they're not going to be really that interested in what's happening in Italy or Spain, and then ultimately the fissures in the Eurozone will not be sort of covered over with this Euro-wide bond. They'll actually be accentuated, and eventually you're going to have some kind of disruption which will lead to a breakup of the euro. But that would argue for the euro to strengthen first and then weaken, or how do you see that? Because the Italian situation and the Southern Mediterranean situation is a very dire one.
Yeah, I think that's right. I mean, I think that's well said. I mean, I think it's very difficult, I think, to get a sensible read on what's happening because of these sort of violent cross currents. But I would say two things to sort of address your question. I mean, one is that if you look at what German industry has been doing in terms of its investment patterns, which is something I cover in the book I wrote, Capital Wars, which is all about essentially the shift of capital eastwards. What it shows there is that remarkably, within less than 20 years, from basically 2000, comparing 2000 with now, what you've seen is German industry completely refocus away from the periphery of the Eurozone and, one would have to say, the US. So it's divested relatively from those areas, and it's redeployed capital, and we're talking about something like 20 percentage points of its entire FDI stock, not flow, stock has been refocused on the East, which I include Eastern Europe, Russia, and China. So there's been a huge move of German capital eastwards. And that's telling us, I think, an awful lot about how Germany reads, or German industry reads, that southern fringe, the Mediterranean bloc. And economically, German industry is moving with its feet. So I think that's one observation. And that will basically, that will be reflected in economic data and ultimately currency strength. So the euro is becoming more German, if you like, more German driven, and more like a Deutschmark. The second thing is that if you look at, go back to the interwar period and look at what happens during these periods, the key lesson is what happened to the French franc. And this may be exactly what we're looking at right now, is that the French franc was the strongest currency in the world until it was the weakest. And in 1935-36, the French franc was very, very strong. And then it just collapsed under the weight of, under the demise of the French economy. And therefore, one shouldn't rule out the fact that these currencies can be highly volatile during these kind of periods. There's a lot of lessons that you can learn from going back to that period. And, one of them is basically, again, relating to the dollar, is maybe how quickly currencies can fall out of fashion. And if you look at the US dollar, which is another example, in 1914, the US dollar was quoted in fewer markets than the Austro-Hungarian krona. Now, that may be, to historians, not a great surprise, but that was a fact. By 1925, when sterling came back onto gold, allegedly, it was not said sterling returned to gold, actually it returned to a cross rate against the dollar, and sterling was quoted at $4, 8 shillings and sixpence, or whatever it was. Oh, sorry, $4.86, I should say, per sterling. And that was, the reason for that was that the dollar by that stage, within 10 years of the start of World War I, had become the dominant currency in the world. And the dollar was by then already the biggest component of paper currency reserves. So within a 9-year period, the dollar had become, or 9-10-year period, the dollar had become the paramount currency within the world. So currencies can move quickly, and volatility can happen fast.
Thank you.
Good. Do we? Okay. I think we pretty much exhausted the questions, but if so, thanks everyone very much. We've got another call next week on a liquidity update, which I think is slated for next Tuesday. So I look forward to seeing anybody that comes along then.